a significant risk that people don't really appreciate is the risk of not being invested and the risk of not being able to benefit from that. Like, there are so many people, I mean, I'm sure you know a lot of people who have been calling a property crash for the last 20 years, and they've probably missed out on millions of dollars worth of gains.
Everybody's, have an uncle, a father, some relative in the family. They talk about 20 years ago, that land was this much, or that house was this much, or I had something, I sold it, and now it's millions. We always heard that stories. And I always say that as well. I don't want to be the guy telling that stories. That's why I'm taking the risk right now. Welcome to the Vision Boards. We are with another episode. Our good friend Godfrey is with us. Obviously, I'm going to ask the first question is Godfrey, could you please mention about yourself, who you are?
Awesome. Thanks so much for having me, Eddie. Great to be here. So I'm the founder of FutureRent, which is an equity release solution for property investors. I started the business in 2019, coming out of my own experience as an investor and the problems I was solving for myself, really.
Okay, that's actually good, because if I was going to ask you that second is we've been talking about this a lot. It's my personal vision about that is great solutions or great inventions actually coming with the problem. Someone sees a problem and try to find a solution for that problem. And obviously you saw a problem. Okay, there was something in there. And then what was the problem and how did you solve it with the FutureRent? And then can you explain us about the FutureRent?
Sure. So look, over the last 20 years, borrowing money in Australia has become a black box. Generally, people don't really know how much they can borrow. They don't know how much they can access. And if you need a small amount, it's very, very difficult. It's as difficult as borrowing a large amount of money. So I come from a property structured finance background, and then I built my own property investment business starting in 2014. And I found that I often had equity in property, but unlocking that equity to invest in the next renovation or the next deposit was very, very difficult. So typically people do what's known as a cash out refi, where they're really refinancing their entire mortgage when they might only need a $50,000 or $100,000 deposit or a small amount of liquidity for another reason. So I figured, look, there's got to be an easier way. There's got to be a simpler way than replacing your entire mortgage if there's nothing that's actually wrong with it. So with FutureRent, we give property investors access to some of the equity that they've got in their property, and it gets recouped from just a portion of the rent over time.
Okay, so am I understanding right? So you're basically helping them to give a portion of their equity, and then they pay that back with the rent.
Exactly.
Okay, so and they don't have to get involved with the bank.
Exactly.
Oh, that's awesome.
Exactly.
That's great. I personally gone through the same thing as well. And one thing is I realize when you're trying to get use the equity, doesn't matter how much and how much you're asking. You're absolutely right. When you're looking for a small amount, like $50,000 to $100,000, it's more complicated than getting a new loan. It's some reason it's taking longer. And then they asking more documents about that. So, but you're helping with the people. Okay, so my next question is, what generally people using that equity for? When they, for example, I have a property and I have if we give a numbers, probably it's going to be easy. I have a $200,000, $300,000 equity in that property, but I need the money. Personally, what I can think of is maybe renovation, maybe second house, another investment. What generally people are using that money for?
Yeah, exactly right, Eddie. So usually it's financing a deposit for the next property or financing a renovation. But it really depends on what stage of life you're in. So most of our clients are sort of similar age to you and I, in their 40s, and they've been, I guess, lucky enough to have started already with whether it's an owner-occupied property or an investment. And they've if anyone who's bought in the last 10 years has made money, right? So you're sitting on some equity, but accessing that is really, really difficult, right? In that example, someone who's got, say, $300,000 in equity, if it's on the one property, they could get basically up to half of their equity, but it's $100,000 cap per property.
Yeah.
But we've got many clients who have multiple properties who might have $400,000 or $500,000 that they've cashed out on those properties to make their next move.
That's pretty good. Like, because I've seen that firsthand with some people, they planning to sell the property. That's another like I start thinking about the solutions you're creating right now. It's they're planning to sell the property. They know property is not in the right conditions, but the problem is they don't have the money. They either retired or some reasons and you can actually help them by giving that money for the renovation, and then they can sell that property with the higher value as well. Or the young people, they have first investments, but it's hard to get this deposit to put it together for the second one, which is generally the second one is always the hardest one. After that, it's getting easier and easier. So you're helping them with that as well. Okay, from the way you're saying is how the investors like actually using this in real life. Like it's, can you give us some examples, like without giving obviously the names, like? But
yeah, sure. No, I can definitely give you examples. So we're sort of fortunate in that now we've been in business for 6-7 years. So we've started to see clients who have come to us over a long period of time and been able to track their journey and the outcomes that they're getting. And I'll give you an example. I've got a client called Naveen who's based over in the southeastern suburbs of Perth. And he's 45. He bought his first property when he was 34 years old in the southeastern suburbs of Perth in a suburb called Gosnell.
Okay.
And bought it for about $400,000. Fast forward about 5 years, he's sort of he's just basically 39, 40 years old, came to us and he was living in this property. And he realized, you know what, I'm not getting to where I want to be financially in terms of I can't really see how I'm going to be able to retire, and we're outgrowing this place and we need to be able to, the property's done well for me, but we need to be able to make more, right? And that's the reality at the moment of really, I think a lot of people, right? Your property often makes more than your income.
Yep.
Right? It's very hard to keep pace with the rate at which property has been growing. And that's due to a whole host of other reasons, right? So he at this point said, okay, well, you know, I've got equity in that property. He'd bought it for $400,000. It was worth probably about $600,000-$700,000 at the time. And he came up with a plan. He said, okay, I'm going to move out of this property, rent it out, cash out some of the equity that I've got in that property and buy another investment, right? So Perth's been obviously on a tear.
Yeah.
It's done incredibly well. But he used that deposit. So he basically cashed out a bit over $50,000 with us, which equated to about 2 years worth of rent on that property. So he used that as a deposit to buy his next investment property in Harrisdale, and he just moved into a rental, right? Now, Harrisdale, I don't know if you've sort of kept track of some of these suburbs. Now, this is about 35 minutes outside of Perth.
Okay.
So great spot, right? He bought this place for about $550,000, right? Now that place would be worth probably $1.2 million, right?
You can save that money by working. There's no way.
You can't. And I guess like we're sort of fortunate now where he went through a full cycle where bought this place around 2020 and 3 years later, so when he originally bought that place, it was rented for about $470 a week, right? 3 years later, he was able to actually cash out again on that first property that he used FutureRent on, because essentially it had repaid, took out about $60,000 on that property again. This time used it to renovate that property in Harrisdale, right? Just basic stuff, right? Paint, carpet, bit of flooring, right? A little bit of new appliances, that sort of thing, right? Managed to take that rent from about $470 a week to about $750 a week.
Wow.
Right? And And now, by the way, that rental's up more like $950 a week.
Do you think, I just wanted to ask you a question in there. Obviously, it's a dollar value in there. It's like you're getting a better rent. But my personal, that's why I wanted to cross-check with you. When you're going a higher rent, you're getting a better tenant as well. Do you believe that?
Absolutely.
Yeah.
Absolutely. There's it's very much a game of relativity,
Yeah.
right?
Okay.
In property, and you're getting a better tenant. But when a lot of landlords in Australia, they're asset rich, but they're cash poor. And as a result, they neglect investing
Yep.
in their property. And, yes, this property benefited from, I guess, being in an area where there was both capital growth and rental growth. But unless you can reposition that property to a level you can attract the right tenants that are moving into that area who are prepared to pay a premium for a nice place, you're not going to get that, right? And we see it all the time where people neglect to or have been neglecting to invest in the basics. Often it's as simple as paint and carpet. And literally sometimes a $10,000, $20,000 facelift on those sorts of basics gets you an extra $150 a week, right? Just straight out the gate before there's any kind of rental growth, right? The reality is, I think in this market, you kind of need to, the best people, they do a bit of everything, right? So they're focused on appreciating the relativities between different markets and where there's a bit of value. But then they're also really looking at the asset itself and making sure that they're not leaving money on the table and they're able to actually take advantage of the changing demographic and what people actually want in different areas, right?
You have a lot of, what I can hear is a lot of clients all over Australia. They just basically, what I can is they're investing in the Perth, they're investing in New South Wales, and I'm pretty sure it's in Melbourne and the other states as well. It's what was the one most strangest the way they're going to use the equity? I know we all have funny stories. Is anyone came to you and asked is I wanted to actually use the cash flow for buying a car or something like that?
Oh, look, definitely.
Yeah.
I mean, we've had people buy cars, go on holidays,
Okay.
do really whatever they want to do, right? Often it's just, especially when you're talking about the sort of, I guess, more of our parents' generation,
Yeah.
right?
Yep.
Often for them, it's more just around just getting liquidity because they want to go on that holiday or they want to buy a car or they want to help their kids buy a property. We've had clients who have, invested it in the share. I had one client who bought shares in Zip before it just went on a tear and managed to sell at the right time and
really?
made 5 times his money on that. But there's a whole range of different uses, right? It's just, I guess it takes money to make money at the moment in this country.
Hey, that's really correct. Yeah, that's really correct. Because of you're an investor, right? It's as well by yourself. It's probably the next question is really important. We've been talking with the real estates. We've been talking about the economist looking at the market, and everybody is talking right now. It's about the market, what's happening, what's the government changes, and then not knowing what's going to happen is the biggest thing. But what do you see in the market right now from your perspective? What's happening? Is the property market is going to crash? Everybody's not people talking, saying many things, but what do you see is Australian markets? What's going to happen in the next couple of months and then next couple of years?
Yeah, I think it's been a bit of a process where initially March, we had a lot of noise. There was a lot of, I guess, things happening politically, overseas, interest rate rises, right? Talk about the upcoming budget, in 2 weeks. And that did lead to a little bit of a standstill, right? Where I think for there were a lot of deals where people were sort of thinking about going through and not really sure, should I just pause on this, right? I think over the last month, people have started to think beyond the first and into the second and third order consequences of these things. And thinking back to even say 85 to 87, where they temporarily abolished negative gearing, right? And when that happened, rents spiked by 35%, right? And my personal point of view, and I think where a lot of investors are sort of seeing this, they're sort of looking at this saying, well, look, the reality is, like, if you're talking about, say, reducing the concession on capital gains tax, you're still talking about taxing me more favorably on something. It's just a question of how much more favorably, right? And it's still been fundamentally the easiest way to make money in this country because we've got this structural undersupply and we're just not building enough. And we can't keep pace with that because there's too much red tape. There's this whole NIMBYism type of culture, right? So ultimately, everyone here invests for capital growth, right? And that's been a very predictable path.
Yep.
And we see it, across our entire portfolio. People often actually overcomplicate, like, oh, how am I going to make money? How is this going to increase in value, et cetera, et cetera. But really, like, as long as you're buying, or at least what we see, more so properties with a, higher land value content, where we've seen more so just houses as opposed to units, performing really well. God's not making any more land, right? So it's just something which is just consistently appreciated. And as the government prints more and more money, and the actual best way to hedge that is in property, right?
It's at the end of the day, like, this is just a conversation between us. We are not financial advisors. It's all coming out from the personal experiences, and what we are seeing out there is like what you were saying is the supply issue. We've been talking about this so many years, and then by the looks like we're going to talk even more. The supply issue is not changing. I don't think anytime it's going to change as well. Can we say just because of that, current changes happen, is going to happen in near future, maybe it scared some of the investors for a short term, but the market is just going to adjust itself automatically because of the supply issues. Can we say that?
Yeah, look, I think that there's a reasonably healthy, like, there's probably the healthiest level of, or the most significant level of participation by investors in the market than there's been in the last 20 years, right? And that's because it's just become plain as day for people to see that the supply issues aren't going away. The only area where, the government is building or meeting their housing targets is Melbourne, right?
Yeah.
And their prices have been very flat, right? And there's probably a case to be made around, that being relatively affordable now and potentially, something which can increase in value at a faster rate than it otherwise has. But I think it's a fair assessment in that, people are ultimately just looking at it and saying, well, this supply problem is not going away. Prices are increasing and going to continue to increase. This is probably the easiest and the safest way for me to make money.
I want to go back to the FutureRent. I have actually more questions about it. But I wanted to actually ask a question about, if you go to the other side of it, like, what is the most important thing is, like, when should investors, like, when people actually using that money through the FutureRent, what they have to be careful about? What do you see over the years, all that experience? What can be a problem?
Yeah, look, I think, like, I mean, you sort of, I guess in jest raised the silly uses of FutureRent, but, in our experience, property investors are actually really generally very financially responsible people, because they're generally investing for the long term in the future. They're not looking to make a quick buck. They've often got their house kind of in terms of their own PPR, and they're thinking, okay, well, I'm prepared to take some short-term pain in terms of maybe it's going to cost me $1,000 or $2,000 a month to hold, but I'm prepared to take that short-term pain for long-term gain. So I'm going to go and buy an investment property, right? And they're sort of planning for the future. I think that people need to make sure that they've got the right level of cash buffers, right? They need to make sure that they stress test their scenarios and they've got a margin of safety, right? That's actually like something that we help people with a bit as well, where, you want to make sure that you've got a year's worth of runway or more, right? Where if you lose your job, you don't have any income, you're going to be fine because you've got a cash buffer that can cover your mortgage, cover all your costs, right? And I think that's really important. You don't want to overtrade, right? You can take on too much debt, right? But generally, like our system here in Australia is actually very conservative, right? And the banks are assessing people at a 3% buffer to where the rates actually are, and they're haircutting your income, and they're not including a whole bunch of other income, right? So if anything, it's more so a question of people, I think, being restricted from accessing money they can actually afford, right? I think there's something which maybe it's more of a personal thing, but I think it depends on your circumstances, but it's definitely a real risk, right? And a significant risk that people don't really appreciate is the risk of not being invested, right?
Yeah.
And the risk of not being able to benefit from that. Like there are so many people, I'm sure you know a lot of people who have been calling a property crash for the last 20 years and they've probably missed out on millions of dollars worth of gains, right?
Everybody's, have an uncle, a father, some relative in their family. They talk about like 20 years ago, that land was this much or that house was this much, or I had something, I sold it and now it's millions, right? We always heard that stories. And I always say that as well. Like, I don't want to be the guy telling that stories. That's why I'm taking the risk right now. And which is you are that kind of a person as well. Like, main reason I want you to be here today is like, whenever I met with someone again, and that someone is unique, what they're doing unique. I wanted to actually tell everyone around me, it's like, hey, I found something, all right? Like, because if it's something, it can benefit everyone. What you're providing as a service, it's something unique. Not everybody is doing it. And it's worth to actually coming here, talking about, and then actually giving an opportunity to other people, like everyday people, to know about it. Like when people professionally in the investment industry, like they are professionally doing that, they have multiple the properties, most likely they know you, all right? But when they have one, they are just getting into it, all right? Like it's hard to know the knowledge, find that knowledge, or they don't even know where to look at it. So that's why we are doing it, and it's really helpful for many other people. So if someone's watching this right now, and then they don't have any experience, they don't, it's not really FutureRent related question, but like because of for your experience, it's like if they're watching someone right now, it's like, and they're planning to do that, they are planning to do the investment, or just thinking about it. What would be your advice to them, like where they can start?
Yeah, look, I think that people tend to understand their local areas well, right? And that's a good thing and it's a bad thing. It's a good thing where they can afford to participate in that area. It's a bad thing when they don't look beyond it, right? And there's in these things, there's, I guess, no simple answer, right? Because it depends on what you can afford. It depends on what you can do. But most people end up putting it in the too hard basket and overcomplicating it.
Yeah.
Right. But the reality is, if you just look at the capital cities and the national average for the capital cities, they've gained 6% a year in the last 20 years, right? So if you're talking about a property that's, I don't know, let's see, say 500,000, for example, you're talking about, say, $30,000 a year in gains, right? Every year. And you multiply and you compound that out and it becomes even more, right? So if you hold that for 10 years, you're probably doubling that money, right? You're never going to save that,
No.
right? So the best way I believe to really look at it is, look, you're not investing for income. Income is purely the oxygen that allows you to hold that property. You need to have a good income and a decent, stable position. So I guess, going to be able to hold that for the long term. And then you just need to let the time do the work. So it's a balance of, kind of being, I guess, action-based enough to take the step and make the move. And at the same time, like, just, thinking through where do you see value and where do you see relative value? Because there's always value. Even now, for instance, people would look at, say, that client that I talked about earlier who bought in Harrisdale, and they'd say, oh, but that was back in 2020. How do you do that now, right? And literally, that same client now is buying just a little bit further, 10 minutes over down the road, a place called Seville Grove, right? You can still buy there houses for, say, 600,000 on 900 square meter block, right? That actually you potentially can in the future, subdivide if you've got the capital to do so. And you can still get a reasonable yield. So there's always relative value, whether it's postcode snobbery or just, the next or the preference for one particular area over another. And what happens is it just gets more and more expensive, and then people move to the next suburb. They move a little bit further over.
This is becoming an overflow area. Like, people can't afford that area. They're just going to the next suburb and the next suburb. And there is always going to be a next suburb, basically. When I started my my own investment journey, I had no knowledge. I had no idea. And for me, investment was like, so I'm going to buy something and it has to pay itself. Now, never thought about, like, it's the value. It's going to increase by time. So that's equity. No one told me anything. And then one just family friend over dinner, 5 minutes conversation. This is my 5 minutes is really famous for a lot of people. I mentioned that to many people. That's why. So I always say, like, somebody is 5 minutes, it may change your life. So that conversation for me was just a 5 minutes conversation. It was just basically explaining is like how this system works, what you can do, why you need to invest, and it's going to save your life. That 5 minutes conversation leads to my first investment, and probably I can easily say 15 or 20 years of my mortgage payments. Maybe actually close it completely with that first one. Taking in action is, I totally agree with you, is that taking in action is the biggest problem. People always thinking this is too difficult, I can't do it. And probably the second problem is they don't ask the question. They don't find the right people to ask the question. And that's why we are here as well. Like, so for some people, because it's not like before people going to their uncles, people going to the people, the smart person in the family. Now, the smartest way to find the answer is the internet. So that's the reason we are here, is like, at least we can help some people to find that the answers quickly, easily. And so that's the whole idea. I'm just going to stop in here for a second. I just want to quickly, it's good, man. Like, really like the idea part. Like, I really want to learn about more, because I'm seeing that all the time. When it most likely mentioned that, like, my background is builder. You still have a building company. And when you go to the people and say like, they're just like, I just want to quickly fix the kitchen because of it's in the worst possible condition. And the tenants are complaining and they have to do it. They have to do it.
Yeah.
But there's a lot of other problems. And then when you go back to them, it's like, hey, like, why don't you fix this? Instead of getting a $400 rent, probably going to end up getting a $600 rent. And not only getting an extra money, it's actually, you're going to get a better tenant as well. They're like, oh, we don't have money.
Yep. It's crazy.
Yeah, we don't have money. What about, like, do you have any more? And then you ask the question as well. I do, generally. Do you have any equity on the property? Do you have any mortgage? Oh, no, we don't have a mortgage. So I can't deal with it. I can't deal with the bank, right? And people against the brokers as well. That's another reason. Godfrey, another question is like, why the people actually coming to you instead of going to banks?
Yeah, great question, Eddie. I mean, look, I think that a lot of people, they don't really appreciate the different types of capital and the difference between, say, equity and debt, right? And the most important thing really is that if you've got a mortgage, that's your largest liability, right? That's a big loan. Now, small changes to your interest rate on that big loan add up to significant amounts of money over the long term, right? So if you go and you do a cash out refi and you replace one perfectly good mortgage with a more expensive one, it's going to cost you big time over the long term, right? Whereas if you need just a shorter term equity-like solution where you just need a bit of capital to be able to make your next move and get ahead, that's different to replacing your entire mortgage, right? Yeah. So there's different types of money, and the best investors understand that really property is, as they always say, a game of finance, and there are different types of money. And what you need at different points in time for different things is different, right? So we allow investors to kind of, keep their mortgage in place, refinance only when it suits them strategically and when they can get a better interest rate, right? And if they just need a simpler solution to get some cash so they can buy the next property in terms of the deposit or money for renovation or whatever it is, they can access that really quickly and easily.
Oh, that's really good. Like, because of that's one big problem as well. And another reason is, like, as you said, like, probably the main reason is people actually, they don't want to touch their mortgage because of just $40,000 or $50,000 while they're paying. And then, like, as you said, I'm just trying to make it simple for myself, like people like me. If they are paying a 4%, 4.5%, it's not realistic right now, but like it's a 5% rate, and they just need a $50,000, they got to go to bank, and then the bank says like, sorry, if you have to refinance, new rate is another 2.5% or whatever is more.
Yeah, so, and to your point about like often it seems to take longer when it's a small amount. Often that's because your mortgage broker, and most Australians actually do go straight to their mortgage broker rather than to the bank. But your mortgage broker actually often isn't incentivized to do that for you because it's just as much work for a $50,000 top up as it is for a $500,000 loan.
Yep.
And they might be getting a clawback on their commission, or even if they do get you the loan, they're probably only going to get a very small amount, and literally on an hourly basis for the 20 hours it takes them to process that. That cash out's not worth it.
Yeah. The another question I have in here is like, I think this is really important. All of them was important, but I really like this question is like, why actually, and the smart investors actually growing, but the others getting stuck? Like, how is that happen? Is there a reason? Is there a way to do it? Like, what do you see is the difference between the smart investors and then the others?
Yeah, look, it's a great question. And I think there's two things that you need to be a successful investor. You need income, and then the second thing is you need equity, right? And take, for example, that investor I mentioned earlier. He's managed to build $1.5 million worth of equity off a $40,000 deposit, right? And, but in order to do that, you need both of those components, right? And income might not be personal. It's often actually just to do with the property and being able to, and again, this is not financial advice, but being able to actually cash flow that property, right? So we see, for instance, a lot of investors who do dual income properties, right? Where they, a lot of people nowadays doing granny flats, right? Where they, under a CDC or a complying development, they don't even need to get a permit from the council. They can get a private certifier to sign it off. They'll spend $250,000 on a granny flat in, say, Western Sydney, and they get $500-600 a week comfortably on that granny flat. So they get 10% yield on that structure, which helps bring them up to more like that 5% yield based on today's prices. But often what happens is you're really talking about a yield on cost, right? And even in the last year, in a lot of parts of Sydney where we are now, like we've had 10% rental growth at a average level, right? So you play the long-term game and you don't just look at where you start, but you look 3-4 years down the road and you go, okay, well, where am I going to be? What do I need to achieve? What do I need in terms of income to be able to continue to support that borrowing base? And then if you're buying in the right areas and they're appreciating in value, then you've got to be really ruthless about recycling your equity, right? No one is creating significant wealth by saving money, right? Everyone, at least I know, who's creating significant wealth is doing it by investing in property and by recycling that equity and reinvesting it and leveraging it, right? And using it smart and doing it in a way where they're sustainable because they're thinking about their income as well.
That's great. Okay, Godfrey, we're going to do a quick fire round. I have really quick questions and then, all right, the first one. One mistake to avoid.
Oversupply.
Okay. One thing to focus on.
I would say yield.
All right. One thing people overcomplicate.
Just the whole buying decision.
All right. And the last one is one truth about your industry.
Oh, this is a tough one. Look, I think one of the truths about our industry, which is probably a bit of a reality that no one really wants to acknowledge, is that a lot of people, they don't even know what they're declaring to the bank, right? And a lot of people, they're going to their mortgage broker just because their mortgage broker tells them what they can say, right?
Yeah, okay.
And because the rules have become so overcomplicated that no one actually really knows like what to say and what they're meant to.
Right. Godfrey, can I get one last advice from you to our audience?
Thanks, Eddie. Yeah, look, I think the final bit of advice that I'd have is the old Warren Buffett adage where you have to be fearful when others are greedy and greedy when others are fearful. And I think that this is one of those moments in the market where there are a lot of opportunities and the data often doesn't show the difference between a great property on a good street and a bad property on a bad street. You'll just see the same result. Whereas now there's a lot of better deals out there. Clearance rates are coming down, and that means we're entering more of a buyer's market. So it's a great time to invest. And don't overcomplicate it, but just think about what you would buy for yourself as a home, and often you'll get it right.
Awesome. Thank you very much. Thanks a lot again.
Thanks so much, Eddie.